Never forget that the stock market is a market of stocks. This advice was given to me by Herman Miller. He was a retired accountant back in the 70s when I was a young man spending my misbegotten youth in Miami. And, well, he had seen it all. I mean, he was a bond trader or a stock trader during the Great Depression. He saw the crash of 1929. He'd been through it all. And, well, his advice rings true today. In talking about what to watch in the economy as things develop, one of the things to not watch is the stock market. I mean, it's always been subject to its own ups and downs based on flow of capital in and out of things. It's supposed to reflect the underlying economy, but it rarely does. It's supposed to reflect the long term, but it's usually at best from one quarter to the next. Right now, the disconnect between the stock market and the real world is extreme. Now, that's an opinion, of course, but it's a very widely held one. And you can go out and find for yourself people who have a great deal of experience trading stocks who say exactly the same thing. It's mind blowing. What's happened so far this year is that when the economic crisis started to show up, when everything started being locked down, the S&P 500 fell about 34% and then recovered about half of it. Why did it recover? Well, largely because the Federal Reserve is actually buying stocks. $1.1 trillion worth of corporate debt and stocks have been purchased by the Federal Reserve. This never happened before. And all of the traders and so on said, hooray, and everything went back up. It's wonderful, right? No, it's not. It's only going to make the problem worse. We have this zombie debt, basically, that's just going to be held by the Federal Reserve, and it's just going to keep floating along. I mean, why would they do this? If you were a cynic and a conspiracy theorist, you might say they're just trying to provide an exit strategy for the people, the bond traders, or the stock traders, and so on. And actually, their stated intent is to provide liquidity for markets. Liquidity means convertibility from a stock to cash, which means they want to make sure that everybody can sell things. They're trying to prevent another Lehman 2008. They are literally providing an exit strategy for all of the people holding stock. That's what it's all about. And it will crash further as earnings reports come out, as the extent of what's going on becomes obvious. Even the Federal Reserve will not be able to support this. And they probably won't try. I mean, at some point, they'll just allow it to ease down gradually, avoid the plunge, but it still has to go down. The pressure is there, and you can only push on a rope so hard. So don't watch the stock market. It's meaningless. Now, if you have to watch something, you can look at what's called the VIX, the Volatility Index. Now, this is something which is compiled by the Chicago Board of Trade, not the New York Stock Exchange. And the Chicago Board of Trade, they don't trade stocks, they trade commodities and they trade options. And an option is, well, you can bet on them directly, but what it is it's either the right to sell or to buy at a fixed price sometime in the future. And you can gamble directly with naked options if you want to. It's a very bad idea. But what those exist for is if you own a stock, you purchase the right to sell at a future date for a fixed price. So then if it goes down, you have insurance. And the price of that option floats up and down depending on how popular they are. If nobody wants to buy insurance, then they're relatively cheap. If everybody's buying insurance, then it gets pricey. If everybody's buying insurance, then the volatility index goes up. Okay, that's basically what it is. Now, what is this number? You'll see the VIX published as just some figure that goes through a very complex calculation that I'm not going to explain because I don't understand it. I don't know anybody who does, so I don't feel bad about this. But what we do know is, heuristically, there's a range. Generally, between 15 and 20 is a very calm, stable market. Everything is functioning normally. During this last crisis, we had a historic spike to 82 on the VIX. Okay, so that's the range we're dealing with, 15 to 82. It's currently at 28 as of today, May 23rd. What does that mean? Well, it's down, right? The volatility is down. That means that everybody is happy and they're not buying a whole bunch of options. Well, 28 is still high. 40 is considered kind of a panic level. 30 is danger. We're at 28. What does it mean? Don't know. If the stock market is really going to tank hard, we will see the volatility index go above 40. If you have to watch one thing, that might be it. Okay, you might also be interested in US bonds because money typically rotates from stocks to bonds. The traders don't like to sit cash. It's just, their job is to own something and to make money manipulating money. They're not going to sit on cash. What are you going to do with cash? It's not good for anybody. So they typically will move stocks to bonds to cash, Tinkers to Evers to Chance. Now, what is happening in the bond market? I mean, right now, the 10-year bond, which is a benchmark figure, is at 0.6% interest, almost a historic low. We're very close to the historic lows that were just recently set. One thing you might want to keep an eye on is the 2-year bond could go negative. Okay, again, the time value of money is broken, and this is the thing that concerns me the most in everything. The European Central Bank has already floated negative interest bonds. Basically, you pay them for the privilege of preserving your money for you. Wow. Will the United States do the same thing? It would happen at the low end first. People don't usually pay much attention to those. Frankly, I don't know why we have short-term bonds at this point, because everything is so convertible and liquid through the bond market, but there you have it. The low-end bonds could turn negative. And the idea is that if you're going to have a yield curve that has a nice gentle slope to it, right? That's a signal of a calm market, is that short-term rates are low, longer-term rates are higher. Well, if the long-term rates crash down to zero, which they're awfully close at, that means the short-term ones have to be negative. It's basically the concept here. That could also happen. But generally speaking, just ignore the stock market. It doesn't exist. It's only going to go lower as the true magnitude of this sinks in. Remember, the 2008 Lehman collapse was precipitated by a stock market latch up 1 year in advance. It's common in the popular press to talk about how that was a real estate bubble bursting in 2008. No, it was a bursting of all kinds of assets, eventually even commodities. But it was started a full year before everything took place. The problem with financial reporting in general is that it's done very much like sports. They want to give a number. The Kansas City Chiefs beat the 49ers and, whatever. And so we say, oh, the Dow Jones Industrial Average rose 200 points today on strong earnings from a company that you have never heard of. How is this information useful? It's basically sports reporting. Who's winning, who's losing, that's about it. And you should value it about as much as sports. I mean, you might really enjoy following sports. We used to have sports, right? And it was fun. But the stock market is not a sporting event. It's not all about the competition, etc. It's just all of this reinforces the various myths that exist within our culture. And why does financial reporting do this? I mean, is the press part of a great conspiracy? No, they're kind of lazy, and there aren't that many reporters to go around these days, and they just don't have enough time to do a really good job. You want to find out what's going on, you have to read these bond traders, these forex traders who write 2,000 word screeds or have lengthy videos full of jargon that are difficult to understand. I know this is something I've been working on for 13 years now, trying to understand it all. The long and short of it is that if you have limited time and you want to know what's going on, forget about stocks. Okay? The VIX will tell you if things are going up and down. Short-term bonds could turn negative. Other than that, it's kind of a fantasy world. Never forget that the stock market is a market of stocks. Herman Miller had seen it all, and he knew what he was talking about. All right.